Hello everybody, welcome to Moneyfarm's 2025 Investment Outlook event. This is our annual event where we take stock of things in the markets, we share our views on what's going on, what has happened and what we see in the future. And we also give a little bit of an update of where we are as a company. My name is Chris Rudden, I'm the head of the investment consultants in the UK, and I'm joined tonight by Giovanni Daprà, our co-founder and CEO, and Richard Flax, our chief investment officer. We have many of these events, these are an annual events, so I know many people are joining us for the umpteenth time, so welcome. Obviously you're well aware of what happens every year. Although we're joined by many new people, including, I'm very happy to say, that we are welcoming our profile pension clients. Clients from the profile pension business, which is part of the Moneyfarm family. As we begin to integrate profile pensions further and further into the Moneyfarm group, hopefully we'll see more and more of you in these events. Crucially, the man to my left and his team are the ones who handle the investments in your pension, and so everything that we say today is also, whilst branded Moneyfarm, is obviously very relevant to you. Just to give a quick sense of the running order, we'll start with Giovanni, our CEO, who will share an update of where we are as Moneyfarm as a company, his view on the industry, and the trends that we see occurring. Then I'll hand over to Richard Flax to talk all things markets. First, we'll look back at 2024. Then we'll take a look at what that means for our long-term view. And then we'll finish with just the things that are on our minds about 2025. We want to make these as interactive as possible. So at the bottom of your screen, you should see a box that is labeled Q&A. Please add any and all questions that you have, the more the merrier. I will try to address as many as possible to the panel this evening. But rest assured, if we don't get to your questions, either somebody in the chat function will, or we will reach out to you directly, either with a profile pension advisor or a Moneyfarm consultant after the event to reach out and answer your questions. Again, this will be recorded, so don't worry if you miss something or you want to go into something deeper. But yeah, that's enough of me. Giovanni, the floor is yours.
Hello, thank you everyone, and I'm glad to talk with all of you, although remotely, but this is an important event for us, and it kind of crystallized the majority of the work we do on our strategic asset allocation, so it's really important as a cadence to start the year. As you know, we started Moneyfarm to really find the perfect balance between cost-effective personal guidance, cutting-edge technology, and world-class expertise. I think the key point for us when we started the business was to make finance more simple and accessible. Accessible in the broad sense of the word, so not just by great user experience, but also to really help you in the decision-making process, which is the biggest and more complicated things to do when it comes to investing. So thanks to our investment advisors and our automated advice and guidance and discretionary management. So that was always the reason why we started Moneyfarm. So we also believe that the industry continued to fall short in prioritizing the interests of investors. You might have seen all the issue around ongoing advice and how people end up paying a lot of commission for things that doesn't really receive. That's just a recent example of why it's continue to be very, very difficult for the industry to prioritize the customer interest above all else. And I think Moneyfarm in that respect was founded with a different perspective, and we think that taking really a very long-term view on the customer relationship is what ultimately makes a difference. So we sit here today in the beginning of 2025, but I remember when we talked to some of you in 2023, 2022 was a very difficult year for all of you in terms of market performances and strategies, and particularly Moneyfarm way of investing, which is based on a fundamental principle of diversification and complementing equity with fixed income exposure, was really shattered in a sense by a year where everything went wrong. But our message, to the point of being in a sense dull, was we have to keep investor, be patient, and 2023 proved that we were right. And I remember also the frustration with some of you, which were customer for a short or long amount of time, and it was really about, do I really trust you? We keep repeating the same thing, stay invested, stay invested, stay invested. Was that really the right thing to do? But the thing is, 2024, we were even more right. So it's really astonishing how the market deliver these performances of in a year where the MSCI World, which is the index which comprises the majority of equity companies, return almost 36 to 38% depending on the currency. So it really has been a year where we were very happy that we convinced our customer to trust us with their money. And even though if saving rate or cash rate might have been high, the reality is that return deliver above inflation earning for everybody who decided and had the will to remain invested across 2022. So we feel very happy about that. We feel very happy about the fact that we've delivered almost 530 million of pound of performances to our customer. And for us, this is real money that comes to you, to your families. And this slide shows you the benefit of those money continues to be invested over long term. In 20 years at a simple 4.1%, which is the expected return of our portfolio, this money will be more than £1 billion. So the tangible benefit of what we do every day, it's really what I think motivate me, motivate the team, and motivate us to provide the best services possible. And in the end, this is what we promise in a sense to our customer, on top of helping them really navigate the financial market and investment. So we come, I think, at the beginning of the year feeling very confident and very happy about 2024. We were also happy about our relative performances. So we monitor ourselves, and Richard is going to talk a bit more about that very, very strictly. And we monitor ourselves as any big $1 trillion institutional asset manager on the planet, if not even more stricter sometimes. And we feel very happy about the fact that 83% of our portfolio on a 3-year basis are in the top quartile. This is not a result that I think should be taken for granted, because as you know, everybody cannot be above average. And I think that with a very limited resources, with a very limited, I would say, team, we can achieve results that compete with the likes of BlackRock, Vanguard, and all the huge players in the market. So I think in that sense, our focus on asset allocation and strategic asset allocation is really paying off in the numbers. So it's also a testament to our investment strategy over the long term. What we always say is not about how, it's about who with. So we want to build a relationship. We are a digital first business, but we do have almost 80 people now as investment consultant that helps our customer, and we put a relationship first. So we don't want to be just an investment platform. We don't just want to be a tool for you, but we really want to be a wealth manager and somebody who helps you, again, making finance more simple and accessible. And we do hope that you are gonna share, in a sense, the fact that we have been loyal partner in the last years. Now let's go back a bit about technology, which is also the other pillar of Moneyfarm. We are a tech-enabled firm. We started with technology from the ground up. Roughly 50% of our business works in technology and product development, so we really do have a heavy component of technology. And what's happening with technology is really, really incredible, in my opinion. So this is the word of Fred Wilson, which says, "I've never seen an environment with more innovation in the 40 years I have been in the tech sector. It's breathtaking to see." So Fred Wilson is one of the venture capitalists that I've been following since a long time ago. He's the founder of Union Square Ventures. They did investment like Stripe, Airbnb. There's a lot of Coinbase, multi-billion-dollar exit for the firm, and he's one of the people which I have seen having the best judgment of technology. So the fact that he says this sentence is really interesting because we are, in our opinion, in a technology super wave. So generally speaking, you have one or two technology who can drive progress, but today you have a combination of technology all happening at the same time. So quantum computing is one, biotechnology, AI, space exploration and travel, and green energy, and all of them is kind of feeding into each other. So AI is at the forefront of the news cycle, but that's accelerating changes in biotech, which is also being powered. Microsoft last week released a new version of a quantum computer, which is expected to accelerate that, and which ultimately is going to accelerate the computational ability to work with AI. So it's all, and AI requires massive multi-billion-dollar investment in energy, hence more investment into nuclear energy, space exploration as well. So it's really about what I think we're seeing is a combination of technology wave that each one of them could change the landscape of productivity, but even putting all of that together, we're really at the forefront of something very, very interesting in the next 5 to 10 years. Also, very unpredictable. So the question for us is like, who's going to benefit from this mega technology wave? Because if this chart explain the concentration of the so-called Magnificent Seven, which is the biggest seven tech stock in the S&P 500, so the Tesla, Apple, Amazon, Meta of this world, they have captured a disproportionate amount of growth in the S&P 500 over the last 10 years, 33%, which is a massive number compared to history and compared to what we've seen in the past. So the real question is, if you go back, 20 years ago, was Alta Vista versus Google, BlackBerry versus Apple, MySpace versus Facebook. So it's really, really difficult to predict which ultimately is going to benefit from this technology and where the value in the technology value chain really lies. An example of that we got when there was the news of this Chinese company called DeepSeek, which effectively were able to create a language model, LLM model, which with a fraction of the computational cost, which suddenly sent the Nvidia stock having the worst one-day fall in terms of market cap for any company on the planet ever. So it's really impressive to see how much volatility there is, and until the technology is consolidated, it's really, really difficult to predict where the value is going to lie, what technology is going to come first, and then you can invest billions on a technology platform that can be obsolete in 1 year from now if something more advanced comes through. So I think our job is really to try to navigate this, both as a company, but also as an investment firm, as well as a primarily user of technology. But the certainty is that the customer will benefit, so we will benefit as users of those technology. But the real question is, how can I capture that value and where this value is going to land? And I think diversification continue to be the honest answer to that question, because whoever that can think to forecast any of this, complex technology and the evolution of that, particularly given that they're in tandem and interrelated to each other, I think is just, in a sense, is an impossible task. And I think that we go back to one of our principles of the strategy, being sure we have a very diversified portfolio where all the companies or the bonds or the emerging market bonds or whatever the asset you have, it really is exposed by this productivity gain in a broad way. Finally, let's talk a bit about what's next for Moneyfarm. We've been continue to grow. We recently announced a new acquisition in the UK, and it's really about creating the sufficient scale and business performance to allow you to continue to reinvest in technology, continue to invest in the service. I think in 2024 we work a lot on our 100% equity portfolio, which is something that you actually requested since quite a long time. We did it in a way that I do hope for those of you who have experienced it was appreciative of the effort we put in also transition and taking the responsibility for transition into a 100% equity exposure. Again, a choice that was quite complicated for us, but we felt it make the process much more simple for you. So we took that responsibility, and I think that is actually working quite well as delivering value for the customer and delivering good performances. In 2025, we are looking at, as we see today, three main things. One is the revamp of our pension proposition, We have a SIP today, which some of you uses, but what we're gonna do is something we think better, that allows us to operate effectively in a way that is more efficient and more simple and with less friction. So really focusing on improving the friction of the journey as well as making it more efficient to access pension. So as well as opening up to have the pension wrapper into our share investing, so our DIY do-it-yourself platform, which is launched last year. Second point is US shares. So we decided to embark on a launch of a brokerage simple DIY platform, so do-it-yourself platform, which we call share investing. We did it because we know a lot of you has some exposure, or want to still have some exposure on what we call satellite assets, so US shares, the Tesla of this world, an ETF which we don't have in the portfolio, so participate a bit more in investing. Still, we believe that the core should be a solid, let's say, discretionary, low-cost managed portfolio, but we do have open up these capabilities, which is pretty new for us. We haven't talked very much about it yet because the product still needs to come to fruition. One of the key points is US shares, so being able to buy on Moneyfarm platform US shares in a different currency, which is what we're working actually at the moment. Finally, we launched a cash ISA. For some of you who knows, we have a very competitive rate with currently it's a variable rate currently at 4.4%. Again, we are not a great fan of cash, but we do recognize that it takes part in the financial planning of every person. So having also that to be able to consolidate everything into Moneyfarm is something that you have asked us for some time, and we decided it was time to do it. So I would say this is just February, so in a sense we are already thinking about these things, and cash is already live. US shares and SIP we expect it to be live next quarter, but we are really continuing to invest in a lot of technology and also to improve the experience on the platform. With that, I will pass him to Richard, and I will happily take questions after Richard.
Thank you, Giovanni. Yes, as you said, we'll take questions for Giovanni at the end. I'll hand over now to Richard Flax, who will talk all things markets, our Chief Investment Officer. We'll try and make this one a little bit more interactive, so as and when you have questions, please fire them through, and I will try to put them to him as we go through it. Richard.
Thank you very much indeed. So as Chris mentioned, we're going to start with a review of 2024. Then we'll talk about our long-term strategic asset allocation process and the results of that. And then finally, we'll talk a little bit about what we're seeing for 2025 and all of the complexity that we see around us at the moment. So 2024, let's start from a macro perspective. There was a divergence, right? And the divergence was around growth. And what the chart shows here is the difference between US growth and growth in the UK and the EU. And really a stark contrast between the US, which showed really quite powerful growth in 2024 and 2023, and the much more pedestrian growth that we saw out of the UK and the European Union. And that growth gap was really been a feature of the global environment for 2024, but also in prior years as well. On the inflation side, however, it was much more aligned. So this is a chart showing 12-month inflation in the UK and in the US, and really a similar trajectory. Right, very strong peaks in 2022 and 2023, and coming down relatively quickly in late 23 and into 2024. And at the moment, it seems that inflation really has settled a little bit above where central banks would like it to be, in the sort of 2 to 3% range. And that's really a question mark from here as to how quickly inflation comes down, whether it does come down, what sort of inflationary pressures we see, and what that means for interest rates and monetary policy going forward. So we did see interest rates come down in 2024, as expected. Perhaps they didn't come down quite as quickly as we might have thought a year or so before. But again, the basic trajectory was progress on inflation, allowing central banks to cut rates after what was a really quite aggressive period of interest rate hikes. And perhaps the more interesting part here is that you didn't really see the recession that many of us might have expected as a result of those interest rate hikes. There have been challenges in the global economy, there have been challenges in the UK economy, But at the end of the day, faced with such a strong hike in interest rates, we might have expected a much worse outcome from a growth perspective than we actually got. But the interesting part here was that inflation came down, policy rates began to come down, but actually bond yields, longer-term government bond yields, didn't really move very much. And in general, were actually a bit higher at the end of 2024 than they were at the start. And that raised some interesting questions, right? Why was that the case? Some of it was a function of the fact that growth was perhaps a little bit better than people had expected. Some of it perhaps was a function of concerns that inflation really hadn't been completely tamed. We were still hovering above that 2% target threshold. And some of it perhaps was concern around fiscal deficits and just how much debt governments had racked up over the last few years and who was going to buy that debt and what sort of yield would investors demand to continue buying that debt. But at the end of the day, it was a slightly surprising outcome. You perhaps under normal circumstances would have expected these bond yields to fall a little bit. So what did that all mean for financial markets? Well, 2024 was really a year of equity returns. As we see here, at the top line, equities generated a pretty healthy return. Commodities did a little bit, and actually government bonds in general were fairly pedestrian, were fairly disappointing, hovering around flat for the year overall. And again, a function of relatively stronger growth, particularly in the US. Interest rates beginning to come down, but still these questions in the bond market around what would happen to long-term yields. But if we dig a little bit deeper into the equity market, we see that a lot of the returns were really coming out of a single market, which was the US. Now, the US obviously the dominant, the largest global equity market. But as we think about the components of those returns in 2024, very much about, how much US exposure did you have? Where was that exposure concentrated? Was it concentrated in the larger US names that Giovanni alluded to earlier? And the answer was the more of those large cap tech names that you had, typically the better you ended up doing. So the gap between US and non-US equity returns was really pretty stark.
Just to jump in here, Richard, actually, sorry, this is a question that's come through in the Q&A, and it's a question we get quite a lot of from our clients in general. The divergence between the US and and the rest of the world, obviously it's mainly in 2024, also it's quite prevalent in 2023. Do we see this as an opportunity in the rest of the world, or is this something that concerns us a little bit about the overvaluation of the US in general?
Yeah, so we'll talk a little bit. I've got some slides in the kind of later in the deck that will speak to that. But there are a couple of points to make, right? Firstly, when you look at the earnings over time from the US market, you see that the US companies overall have really generated faster earnings growth. At the same time, investors have been willing to pay more for US companies to some extent as a result of that. So you've had this sort of, these twin tailwinds of stronger actual profit growth and higher ratings in terms of higher valuations that investors have been prepared to pay. And we'll see later on in the presentation the extent to which US equities have re-rated in terms of the valuation relative to European equities. And so this is an important question that we've debated for some time, right? To what extent do we think that US equities can continue to outperform in the way that they have done? Obviously, the US, it's not just a function of the market, it's also a function of the sector composition. The fact that you have a lot of these large tech companies that have really been growing very quickly and generating a lot of profit and a lot of cash. But at some point, the concern has to be, and we've seen it in the last few weeks, that expectations here are a bit too high. So we think that the US market remains a really important and interesting place to be, but we would always caution about being well diversified within your equity exposure to continue to have exposure outside of the US and outside of the largest US companies.
Thank you.
Sure. So let me just reiterate the point that Giovanni made. Obviously, 2024 on a relative basis, and this is comparing to ARC, was a good year for us. But also when we look out over longer time periods, we continue to think that it's a real vindication of the strategy that we followed, of the sort of low cost, low turnover, well diversified approach that we think has really paid dividends. And the benefit of that low cost approach really comes through over the longer term. It may not make much difference over a relatively short time horizon, but compounding those lower costs really allows our customers to enjoy more of the returns than perhaps they might find elsewhere. So we're happy with the results. Obviously, it's an ongoing process. Last year is gone. It's all about 2025 and beyond. But we continue to be very pleased with the way that the strategy has sort of borne fruit in terms of the returns and the rankings that we've been able to generate. And we just wanted to touch on here the annual performance, and there are a couple of points, I guess, to make. The first is, that you see a range of returns based on the different risk levels. So, the risk-reward equation is still very much with us. The lower risk portfolios have had generally lower volatility and lower returns. The second part is that obviously that markets don't go up in a straight line. And we've seen, obviously, the experience of 2022 when we did see volatility and we did see portfolios decline. And it was obviously very, very reassuring for us to see the recovery that we've seen over the past couple of years. So when I look at this, it's really a reminder for myself, but also for clients, to the importance of staying the course, of sticking with your plan, all of those things that we talk about, but really vindicated, we think, when we look at a table like this and look at the annual returns over time.
No, exactly. And just to jump in on this point, I mean, for fear of repeating exactly what Richard has said, but I really love this slide because particularly when we speak to clients on a regular basis, particularly in periods of kind of heightened market volatility, whether it's on the way down or on the way up, it's easy to get excited or, kind of fearful. And I think taking a step back and looking at the bigger picture, when we always say to clients, take a view of the long term, ride the rough with the smooth, and you'll benefit in the long term. It's slides like this that really show the impact, because particularly in 2022, as Giovanni alluded to, we get lots of conversations from clients around, what should they do? Should they take the money out? Is this the end? And we always say things are going to look bright on the other side. And again, on the flip side, when markets are flying, people always think, well, should I, increase my risk? Should I do more? And again, it shows that markets are cyclical. You'll have ups, you'll have downs, and the key is just to be a lot, in the market along the way. And I think this is really crucial for that.
Great.
Just to take a note, before we jump onto the next section, we'll take a couple from the audience maybe. So, probably as spring budget is coming, tax increases are hitting this April. Will we see an increase in inflation as a consequence? And what would the impact of that be? Thank you, Richard, for that question.
Yeah. So look, I mean, a couple of thoughts on that. It really, and the short answer is that it depends. Obviously, it depends how, what sort of tax increases are put through. Our general thought on tax increases is that there could be a short-term hit to inflation. But in the end, tax increases are generally going to hit domestic demand. And so the longer term implications may be that you see weaker demand and you see a deflationary trend out of this. In the short term, you might see some hits to inflation, but we would be generally more concerned on the demand side if we see big tax increases than we would be on the inflationary side.
Very good. And maybe one more, but keep the questions coming because we'll come to them all throughout at the end. But ESG investments, obviously we haven't touched on it a lot. What happens, so a question from James, can you give an outline of ESG investments, past performance and future movement view?
Sure. So, our general view on, when we take a step back, when we built the ESG proposition, we consciously decided, we said we wanted to be differentiated relative to the classic portfolios. We want to take perhaps a slightly stricter line. We'll give our clients the information to be able to assess what the differences are and if those, if those ESG portfolios are right for them. What we've seen is that the ESG portfolios have gone up or performed. In some cases they perform better, in some cases they performed in line or a little bit worse. We believe that these things will even out over time. So our general thought was, at the time we launched, I think that's still true, is that there shouldn't necessarily be a trade-off in returns from ESG and non-ESG. And there are some reasons why we think that, which we can dig into more separately if you'd like. So when we think about ESG, it perhaps has a little bit more technology exposure. It obviously has we don't include commodities in that, and where we do in the classic portfolios, and so you lose some of that exposure, which hasn't made, we would argue, a material difference to the portfolio returns. We remain optimistic about the outlook for the ESG portfolios. We think it continues to be an important product to offer our clients, and we continue to think that over the long term, we shouldn't see a material difference in the performance between classic and ESG, but it's worth remembering that in any given year we will see these differences, and that's what we did see, for instance, at least a little bit in 2024. So let me turn now to the strategic asset allocation, and for those who haven't followed it, this is a process that we run every year, generally in kind of towards the end of the year, and the basic idea for the asset allocation team is to sort of take a step back from daily noise, market volatility, and really try and look out over a long time period. So we pick a 10-year time period and think about the expected returns that we could achieve across a range of asset classes. And the idea of it is to be a fairly mechanical process, right? We want to try and take out as much of the discretion or the human emotion from the discussion. And we try and pair it right back to the things that we think are the key drivers over the very long term. So it's about economic growth, it's about inflation, and it's about starting valuation. And really combining those three things into a set of expected returns that we can then turn into sort of strategic portfolios. It's worth highlighting the strategic portfolios are not the portfolios that we see today. Those are the tactical portfolios. But really for us as an asset allocation team, they are guardrails that we use to inform our thinking, to inform how we think about the world, but also to be able to provide context to our clients about what sort of returns we think you could expect to receive over the long term. So with that in mind, let's turn to the expected returns that we generated for 2025. Remember, these are annualized returns, so looking out over 10 years. And there are a few points to highlight. First is that these are generally returns above inflation, which is good. So we continue at the very sort of most basic level, we think that investing in financial markets remains a worthwhile activity. Something that you're going to be paid to, we think you'll be paid to do. The second is that, as you might expect, you do continue to get a higher expected return for taking on additional risk. So emerging market equities have a higher annualized return than developed market government bonds. And that's it sounds obvious, but it remains an important consideration. So when we look at that, some of the returns, as we'll see in a minute, for, say, developed market equities are lower than perhaps they have been in prior years. And really that's reflecting the strong performance that we've seen over the last couple of years in the equity markets. But we continue to think, when we look at this particular slide, that the long-term returns across the asset classes remain quite appealing, and we think that that's important as we think about the multi-asset portfolios that we run. So let's try and put those numbers into some sort of context. And as you know, we've been doing this for a number of years now. The methodology changes a little bit every year. We sort of tweak it, but not materially. And so we want to put those expected returns that you just saw into a historical context. And so there are a couple of points to make here. Firstly, on the right-hand side, you see that the returns for bonds have gone up significantly over the last couple of years, really reflecting the rise in interest rates in 2022. And actually, it was painful at the time, but from a long-term perspective now, it's pretty important, because it means that we can continue to manufacture a return for clients, we believe, across the risk spectrum, from low-risk portfolios to high-risk portfolios. And obviously, in the low-risk portfolios, to manage the downside risk, bonds make up a more important part of the asset allocation. And so it's been really, really helpful to see that you can generate those returns, we think, in bonds in a way that perhaps you couldn't, particularly in government bonds in the period sort of 2020, 2021. The second point, I guess, is as I mentioned, the expected returns for equities not quite as high as they were in 23 and 24, again reflecting the strong performance that we saw in the last couple of years, but still perhaps higher than we saw in the earlier period, and we think robust returns that will help really drive client portfolios in the higher risk levels. Again, here is just a sample of the 2025 strategic portfolios. Again, a relatively well-diversified approach in terms of bonds in the low-risk portfolios and increasing the equity allocation as we go up. We continue to think that having a broad range of fixed income exposure in those low to mid-risk portfolios, developed government bonds, inflation-linked bonds, investment grade, emerging market debt, all of these things we think are valuable contributors to the risk and return of these portfolios. And then we just wanted to take the long-term expected returns that we had and apply them to our existing model portfolios, the portfolios that our clients are currently invested in, to generate those sort of long 10-year annualized returns. And these are annualized returns. So here are a couple of points to make. Again, firstly, reassuring to see that you get paid to take additional risk, we think. Higher risk portfolios generate a higher return than low risk portfolios do. It's not a given. It's normally the case, but it's always worth checking. The second point is, I guess, the spread between a low risk and a high risk portfolio. So 3.2% in a level 2 and 5.4% in a level 7. That spread is probably a little bit smaller than it's been over the years, if we look back. But again, important to remember that 2% a year annualized for 10 years really makes a material difference. So we think that there's, continues to be good opportunities for low risk portfolios. But again, you are going to be paid, we think, over the long term for taking on that additional risk, provided that's consistent with your risk appetite.
Yeah, very good. I think there's a couple of questions. Maybe we'll take one just in the interest of time. Anthony Lupton asked, government bonds have traditionally seen as a lower risk foil to complement equities. In the past couple of years, they've become more volatile than equities. Will this trend continue, or do you see government bonds as being a key component of mainstream investment portfolios? Obviously, you touched on it a little bit, but maybe if you want to elaborate.
Yeah, no.
The last two versus our view forwards, perhaps.
I mean, a super important question, so thank you very much for that. Look, I think that there were a number of valuable lessons for investors particularly from 2022 and really around duration, about the volatility in returns that you get from longer dated government bonds. And we had seen some very long dated, in some cases 100-year government bonds that had been issued in the years prior to 2022, and you saw some really sharp declines. So I think so I would say a couple of things. One, clearly a real appreciation for duration risk, as it's called, and so we should be mindful that we're being paid to take on the additional risk from longer dated bonds. However, our starting point to answer the question precisely is that we've seen a real repricing in 2022 in terms of government bond yields and yields generally. In fixed income, and we believe that going forward we are in a position to use bonds to enhance the returns of portfolios, particularly in the mid to low risk, but also to manage that risk. We do think you're going to need to continue to be careful about the duration risk that you run in those low risk portfolios. So we should be sure that we're being paid to take on longer dated government bonds relative to shorter dated government bonds. But we think in general the fixed income space looks better value than it did, and it can be an important contributor to both risk and return in portfolios, particularly, as I say, in the mid to low risk. Cool. Let's turn now to 2025. And it's been a pretty noisy start. So look, the first chart here, this is an index on political uncertainty, which in the US, which sort of tells you what you would expect, right? Which is that political uncertainty has gone up. And actually that's what this index does. You can more or less get that from reading the newspapers. It's not quite as high on this metric as it was during COVID, for which I think we should probably all be relieved. But again, the direction of travel is there's an awful lot of noise in markets. There's an awful lot of noise in policy and politics. And that's going to continue to be the case most likely. And so we need to think about how we construct portfolios that are able to deal with what any challenges to markets that come along. The second point is really about interest rates, and we saw interest rates come down in 2024, and there was really a point in time where there was a lot of interest rate cuts expected over the course of the next 12 to 18 months. And what this chart tries to show is the extent to which that's really changed. from where you were in, for instance, September 2024 in the US, where you were expecting 2.5 percentage points lower policy rates, to where we are today. Now, important to say that some of that is a function of the fact that interest rates have come down. But again, expectations for interest rates have fallen. We still expect interest rates to come down in the UK and the US in the course of 2025, but not particularly sharply. You'll see maybe a couple of cuts. And that's really, predicated on our view that the US economy, the UK economy will continue to grow. The US probably grow faster. That there will still be some questions about inflation, particularly maybe if you begin to see tariffs measures being really put on. So we think rates can come down a little bit, but perhaps not as sharply as we might have expected 12 months ago. Now let's sort of to come back to the policy risk. Again, there's been a lot of discussion of tariffs, a lot of tariff threats, a lot of threats of reciprocal tariffs, and it's interesting to see here how that's already factoring in to consumer expectations in the US. This is a survey from the University of Michigan asking consumers what they expect inflation to be in 12 months' time. And what you see here on the chart is that those expectations had been steadily drifting down through 22 to 23 to 24. But with all of the new policy noise that we've seen, you've really already begun to see a pickup in inflation expectations. And we think that's important for a couple of reasons. One, inflation expectations do embed themselves, we think, in actual inflation over time. But also it somehow informs policy making. Inflation was a big issue, we think, coming into the US election last November. And a lot of US consumers said this was US voters said this was one of their prime issues, was the state of the economy. And so if you were to see a revival of inflation, it's something we think that US policymakers will need to consider as 2025 progresses. So now let's turn to equity markets, and I showed you we showed you the chart of equity returns in 2024. This is really showing a chart of global equity valuations. And it's a straightforward forward price earnings ratio. The three straight lines are the average, and then one standard deviation out of sight. But the basic message here is, global equities do look relatively highly rated versus history. Not as highly rated as we saw in 2020 and 2021, but certainly higher than they have been over the last couple of years. And that's perhaps to be expected given some of the strong performance that we've seen, particularly in the US. And it's very much something, as we think about the long-term returns that we showed you, which were perhaps lower than we saw in the past, and we think about the 2025 returns, it's an important thing to bear in mind, because we are not expecting to see equities return the sort of numbers that we saw in 2023 and 2024. And the starting valuation is at least part of that. And we alluded to, this is in answer to the question that Chris posed earlier on. When we think about the relative rating of the US relative to Europe, and this is comparing the one versus the other, we've seen this sort of steady re-rating of the US relative to Europe over the last decade. And that represents a challenge because, obviously it's easy to say coming into 2025, US stocks look much more expensive. Surely we should be selling them and be buying non-US stocks. And it's a fair argument. It's an argument that we've made a number of times over the years. But as you can see from the chart, it's an argument that you could have made unsuccessfully for the last decade. And so we think that the valuation gap is significant. It's certainly something that impacts our thinking. But we're very mindful of moving too aggressively because, again, we've watched this pattern unfold for a number of years. And it's also worth bearing in mind, we don't think that valuation in and of itself is enough to, really to drive short-term equity returns. We think there need to be other catalysts and other considerations to drive equity returns, particularly over a 12-month time frame. Over a longer-term time frame, the starting valuation is pretty relevant, we think, but over that 12-month time frame, it has less of an impact if we look back at history. It's also worth bearing in mind, I made this point earlier on, and it's worth repeating, that it's US outperformance is not just about valuations. right? This is looking at 12-month earnings for the US and for Europe, going back some 25 years. And you really see over the years, particularly since the global financial crisis, the extent to which US companies have simply generated much more profit growth than European companies. And that really does explain a lot of the outperformance that we've seen in the US over the last 10 years or so. And so as we turn to 2025, this is looking at expectations for earnings growth for 2025 and how those expectations have changed over time. The top line is the US and the bottom line is in this case the FTSE 100. And again, you see that this expectation that US companies will grow their earnings faster than UK companies. Now again, we have to have a debate around will this happen? And to what extent is that valuation gap already reflecting that? But it's worth bearing in mind that at least as we sit here in February 2025, there's still an expectation that US companies will be able to grow their profits faster than most of the rest of the world. I wanted to talk a little bit about AI. AI obviously a meaningful driver of investment spending, a meaningful driver of stock market returns, particularly for some of the large tech names. Giovanni mentioned it earlier on in his speech. But I think from a macro perspective, what we really care about is the extent to which all of the investments that he alluded to can really show up in terms of productivity. We care about productivity because it's a way to allow, we think, the global economy to grow faster, to generate more opportunities for companies, to generate better income for households. And so, wherever it comes from, we want to see whether that's really the case. And so this is a measure of US productivity over the last sort of 70 years, along with a trend line. And we've seen periods where productivity has lagged. And you think back to the mid-70s, really to the early 2000s, a period where productivity in the US was not particularly robust. But what we see on the right-hand side of the chart here is that we have seen, particularly since 2020, a pickup in productivity growth, a pickup in productivity. And we think that some of this perhaps reflects the increased investment that we're seeing in the IT space, in terms of the innovations that Giovanni alluded to. And potentially, if we begin to see this trend continue, this can be a real driver for US economic growth, for global growth. And what we're really talking about here is being able to see that innovation translate in a macro sense into opportunities for households and for companies that can drive growth going forward. And we thought it was super interesting, so I actually put in another chart about this. What we're seeing here is productivity in the US for manufacturing relative to total productivity. And what you see is that actually manufacturing productivity has really gone nowhere for the last 15 years. If anything, it's sort of drifted lower. But outside of manufacturing, I guess particularly you would argue in the tech space, you have seen this really meaningful increase in productivity in the way that the tools that we all use in the technology tools that we use every day are really showing up in terms of the growth that we see in the US economy. So we are seeing that. It's not all one way. Clearly, manufacturing in the US has not been as robust as it was. But we think that this productivity trend is something that can continue, something that can feed into global growth and create opportunities, we think, in financial markets as a result. So with that, let me make a couple of comments about sort of the key takeaways that we draw from all of this. I guess the first point is that the long-term returns remain attractive. Going back to the strategic asset allocation point, slides that we showed earlier, you can continue to earn a decent return, we think, from financial markets, a return consistent with your risk appetite. And at the end of the day, we think that's really important. That underpins, obviously, our business and the proposition that we offer to our customers. The second point worth making is that we think that the macro backdrop looks pretty good. Cutting interest rates doesn't necessarily mean that it's good for financial markets. What you really want to have is a combination of lower policy rates and economic growth that is still positive. Now, the good news is really over the last couple of years, we haven't really seen a recession. In Europe, we've seen growth be pretty stagnant. In the US, it's obviously been much stronger. But at the end of the day, we've seen policy rates come down at a time when economic growth has actually held up. And that's been a pretty positive backdrop, we think. With that in mind, we should acknowledge that policy rates, we think they can fall a little bit, but not much more, particularly in 2025. Maybe we'll see a couple of cuts. Again, predicated on the idea that we're not going to see a recession. If we do see weaker growth than expected, that equation will change. The next point is that there is a lot of policy uncertainty. You see it every day. It has an impact on financial markets. That can move both ways. But it is something that we think we're going to have to live with for the next, certainly in 2025. And it does impact our thinking about how we should construct portfolios. And then finally, on the valuation point, again, underpinned by the long-term expected returns that we have, we don't think we're going to see the sort of returns we saw, particularly in US equities in 2024 and 2023. We don't think we're going to see a repeat of that in 2025. But we think that the combination of strong earnings growth and perhaps higher starting valuations will dampen returns, but you'll still be able to generate, we think, positive returns over the long term across the equity space. So what does that all mean for portfolios? Right?
Yeah, thank you, Richard. I mean, obviously, in the interest of time, we were hoping to squeeze in a few questions at the end. Maybe I'll combine a load of them into one for you, and then I'll put one to you, Giovanni. There's been several questions from Paul, who said, do you see 2025 as the year of the bull market starts to wane, or do we think it will continue? Paul West, US policy on tariffs drag on economic growth. I think ultimately the question that everyone's asking is, what does that mean for the portfolios? Yeah. Obviously, we're looking at, where we are now, what are we thinking the next moves might be, or the things that we're looking at specifically?
Yeah. So look, I mean, our view on this goes something like this. Again, we think that you can earn a decent return across the asset classes that we invest in. We think that the returns that we saw in 2024 won't be repeated. We think that we'll see lower returns, and we think that given where starting valuations are, we think that from a long-term perspective, that would be a healthy outcome. Again, lower positive returns than we saw in 2024, we think would be a good outcome. You're sitting there compounding those returns over time, and we think that that's pretty powerful. Onto the question of tariffs. Tariffs remain clearly a potential downside risk, and we think that they're a downside risk to growth. We think that ultimately a round of tariffs would be a dampener to domestic demand. We would expect them to be fed through to customers initially in terms of perhaps higher inflation, but ultimately in terms of lower demand growth. And so that's something that we need to keep an eye on. But when we think about, as I say, the full range of expected returns we have, we think that there's a lot of tools in the toolkit that we can use to build portfolios that will generate solid returns over the long term.
Brilliant. And maybe time to squeeze one more for you from Roger. And again, similar points. A lot of talk of US stock market overvalued due for correction. Lots of investors like Warren Buffett taking records amount of cash. What's our view on this?
Yeah. So, I guess a couple of points to make. As I showed, the US equities look more highly rated than they have done in the past. We continue to think that there are great opportunities in the US market. We obviously have a meaningful exposure to the US. It's worth bearing in mind that the last changes that we made in the US were buying equal weighted ETFs, so trying to diversify our exposure a little bit away from just the largest 10 or 15 companies in the S&P 500. And we think that's a good strategy. We want to maintain that diversification, not just across geographies, but also within large markets like the US. So, again, we think that the absent some change in the macro environment, we think that the higher starting valuations will have an impact on longer term returns, and we think that we factored that into our thinking around how we should position portfolios.
Thank you, Richard. And Richard, I hope that answers your question in the Q&A. But finally, one for you, Giovanni, from Collins. Thank you for the question. And it's something we've been facing a lot in recent weeks. With the launch that we've just launched of the Cash ISA, obviously this is making the news quite a lot recently, with Rachel Reeves touting a cut in the Cash ISA allowance or removal completely. What's our view?
Yeah, I think that we think that really it's important that the UK government focuses on growth because in the end of the day, cutting saving allowance, I think it's really impede one of the best assets we have, and people need to save more actually. So this is a country where there is a below rate of saving, particularly across pensions. So I think that if they would have said we cut cash for stocks and shares, we would be very happy. We think that's the right way to incentivize long-term investment, but just cutting cash as a allowances, which means again increasing taxes, particularly touching saving, which is one of the assets we need to encourage people to do. I think it's really goes in the wrong direction personally, and we need to encourage more investment. I think as a country in the UK, more maybe even local investment to a degree, but that's I think is just kind of goes in the wrong direction in a sense.
Brilliant. No, I agree. Thank you all. I think that's all we've got time for. Again, reminder, if we didn't get to your questions, we will reach out to you directly after this. And as always, our team, the investment consultants or the profile pension advisors are always on hand to answer any questions that you should have about this, about anything, about the end of the tax year, obviously coming up as well. So please reach out to us to book in some time, reach out via email, on the phone, etc. Again, reminder, this has been recorded and we will share this with you after the event. But that's it from us for now. So thank you all for joining and have a nice evening.
Thank you.